If you're someone who's planning to leave behind a lump sum legacy for your family, then I'm here today to share with you a few ideas where an insurance product could actually deliver you a better return than leaving the money saved or invested. So the first idea is all around leaving a lump sum legacy for your family. So if you've got some spare cash available every month that you're currently putting into savings or investing, why not consider using that spare cash to pay monthly premiums for a whole of life insurance product? Let me give you an example. So say the spare cash you've got every month is £275 a month. For a 50-year-old male, if you pay that £275 per month into a whole of life insurance product, the lump sum payout you'd be due on death would be around £250,000. So if you then lived to your life expectancy age, that's equivalent to a 5% a year investment return, which is not a massive investment return, but it's certainly better than cash savings rates. And remember, this is a guaranteed investment return. It's a guaranteed lump sum payout at the end of the day. You don't get that with investing in the stock markets, which leads on to idea number 2. There is such a thing called investment life cover. So let's say you had already built quite a nice portfolio that you're planning to leave behind for your loved ones. This type of product can protect its value. So let's say just before you died, there was a significant stock market crash. And in the worst stock market crashes, we've seen markets and portfolios fall in value by 50–60%. How would your family feel if that money that you'd worked hard to build up is suddenly reduced by half? Well, then an investment life cover product will protect the value of your investment. So if you die shortly after taking out the product and there's a stock market crash just before you die, the product will pay the difference between what your portfolio was worth and what it's worth after the crash. So just making things a bit more secure and guaranteed. And finally, idea number 3 is all around protecting your spouse's retirement income. So typically when I meet a couple, one of them usually has more retirement income than the other. And this is usually because one of them has a large defined benefit pension. And although the defined benefit pension will still pay out to the spouse on death, it's usually reduced by half. So consider how your spouse will be affected if they've lost half your defined benefit pension income, and also your state pension income will probably be lost on your death. So that could be quite a significant income hit. Again, by using a whole of life insurance policy, you could guarantee a lump sum payout on your death, which your spouse could then use to secure a retirement income to top their income back up to where it was or close to where it was before you died. So these sort of ideas are very useful for people that are perhaps nervous of investing in the stock market or really want to guarantee the payout and legacy that you want to leave behind. For more information, check out our website, rtsfinancialplanning.co.uk.